Hello, everyone. My name is Adel Korkor, and I'm the founder and the CEO of the A.B. Korkor Foundation for Mental Health. This is one of our additional webinars that we're doing to helpfully reduce the stress. You know, as we all know, investing can be tremendously worrisome and challenging. But what we decided to pick a topic today that we think you're going to find really helpful in an attempt to reduce the amount of stress that you have associated with investing. Today's topic of our discussion is worry-free investing, way to decrease the level of stress and anxiety associated with investing. And we're really honored and privileged to have one of our board members, Mr. Robert LaGrant, to be our speaker. There's a lot to say about Robert, in addition to the fact that he is a friend for many, many years and a foundation board member. He is a vice president, a client advisor at JP Morgan Chase Bank. He is also heavily involved in a lot of philanthropic organizations here in Wisconsin, serving on the endowment committee at the Boys and Girls Club of Wisconsin. And he is a money coach, and he is a chair of the educational committee at Secure Futures, a tremendous organization here in Wisconsin. Robert, you can get your camera on.
Afternoon, everyone in attendance.
Hey, Robert, it's so good to have you today, and welcome. I really truly look forward to your presentation. I know you have coached me a lot over the years as well, so I'm thankful for that. And myself and everyone else are looking forward to your presentation. So.
All right, thank you again, Adel, for the invitation. Again, the work that you're personally doing in the creation of the foundation and just figuring out ways to be able to give back to the community at large. So as Adel mentioned, again, my name is Robert LaGrant. I don't like to say facilitator. Again, I'll be leading our conversation today and talking about investing more so from an educational point of view. And so we'll have a presentation and some information to go over, and the majority of our time will be spent in a question and answer format at the end of the event. So we look forward to you being engaged, and hopefully the time will be productive. As Adel mentioned, again, today's presentation will focus on ways to the level of stress and anxiety associated with investing. Again, at this time of year, again, with everything that's going on with the pandemic, our lives seem to be out of normal for just a number of reasons, but just having some opportunity to decrease the anxiety and the stress level along with investing will be beneficial from an educational point on today. Again, a lot of us will see a lot of things with regards to the stock market or the bond market or different types of investments. And we want to spend some time demystifying those things on today. So with that, we'll go ahead and get started with the presentation that some of you are able to see on your screen. Otherwise, we'll be able to describe in great detail for those that are on the podcast. Starting forward, again, our lawyers would always like for us to be able to mention that the material is intended to help illustrate the financial consequences of the concepts and strategies discussed here in very general terms. JP Morgan Chase & Company and its affiliates and or subsidiaries do not practice law and do not give tax, accounting, or legal advice, including estate planning advice. The strategies found herein often involve complex tax and legal issues and are provided only for educational purposes. We are, however, pleased to consult with clients and their legal and tax advisors as they move forward with planning. So as we start off and just talking about investments in general, let's start and talk about what an investment actually is. When we speak to investing, when you invest money, you purchase assets that you expect you will give you a return. So if we go and buy one thing, or if we're able to see something, we would want to be able to have some level of return on that type of investment. Interest from a government bond, dividends paid by a company in which some of you will own stock, and appreciation in the value of real estate are all examples of returns on investment. As we have an introduction to investing today, I want us to be able to focus on three specific topics. The first will be types of assets. Again, we'll discuss in detail, again, fixed income, equities, and alternative investments. The second thing that I spend a lot of time in educational seminars and presenting is risk and return. A lot of times investors are so really involved with the level of return that they don't really account for the risk. So we want to have some conversations on risk versus return. And then for those of you that haven't started the investment journey as of yet, we'll talk about beginning to invest in some ways to be able to get started. Holistically, as we mentioned, there are three broad categories of assets that you can own in an investment portfolio. The first that we'll discuss today will be some level of fixed income, a bond. Again, some of you will be familiar with that. Again, and a bond can range anywhere from a government security to a CD at a local bank. The second topic that we will mention as far as the assets will be equities and what a stock is, what it gives you ownership in, and what it allows you to be able to participate in. And then lastly, we'll fill out with regard to the types of assets, alternatives, which include private equity, real estate, and some type of commodity. Now, first and foremost, again, what is a bond? A bond is any interest-bearing or discounted government or corporate security that will obligate an issuer to pay the bondholder a specific sum of money, usually at specific intervals, and to repay the principal of the loan at maturity. So that says, again, you're borrowing money to someone. Again, a bond is nothing more than a loan in which you are the lender and someone else is the borrower. Again, the biggest issuer of bonds we'll talk to shortly will be the United States government. And there are a number of different ways where you can have bonds as far as the government goes. Again, the organization that initially sells you the bond is what's called the issuer. You can think of it as an IOU given by a borrower to a lender. Again, of course, again, the borrower would require that the investor give something extra for the privilege of using their money. And the extra is usually in the form of some type of interest payment or some type of dividend. Again, when you invest in bonds, it's also referred to as fixed income investing. So fixed income would be the general umbrella and bonds would fall underneath. Now let's dig deeper into what a bond actually looks like and who the issuers will be. As we talk about different types of bonds, there are many different types of bonds and fixed income securities. The United States government can be broadly divided into three categories. First will be treasury bonds, and that's the thing that you'll see most often. Again, the most liquid area of the market. A treasury bond can range anywhere in time period from a simple security, again, going out just a few months, all the way out to 30 years. The U.S. Treasury bonds are direct obligations of the federal government. Again, it's reasonable to assume that the federal government will make good on its promised payments, and these bonds are typically called risk-free assets. So if you buy a bond by the U.S. government, it's backed by the full credit, taxing authority, and also the opportunity to repay by the U.S. government. Again, it is of note, though, again, that treasury bonds will decline when interest rates rise, so they are not free of risk. Again, the only way that you avoid the risk associated with the treasury bond, if interest rates move up, you would have to hold that bond to duration or to its maturity and be able to get all of your money back by the government. Again, just to give you an idea on how big the treasury bond market is, at present, again, the approximate value of the treasury bond market is over $20 trillion. So a lot of domestic investors or even people abroad in international countries will buy treasuries just because of the liquidity factor and also the guarantee by the United States government that they'll be able to repay their debts. The second type of bond that I want to mention is what's called a municipal bond. Municipal bonds are the debt obligations of a specific state or a local government entity. Again, here we're in Packer country again. So when they did the renovations for Lambeau Field about 15 years ago, they issued municipal bonds to be able to attract investors. The same thing was done with Miller Park for the Milwaukee Brewers. So municipal bonds are issued by a specific state or local government entity. Their maturities can range anywhere from 1 month to 40 years. Interest earned on municipal bonds is exempt from federal taxes and from some state and local taxes under certain conditions. So that's something that we can talk to at a later point in this presentation. Just know when you buy municipals, again, depending on the situation in the state that you live in, you don't have to pay federal taxes, and sometimes you don't have to pay state taxes as well. So that makes it advantageous from an investment point of view. By giving up that opportunity and paying taxes, municipal bonds offer lower interest rates than corporate bonds because of their tax exemption. Again, no free lunch that's out there. So again, if you don't have to pay taxes, the yields or the amount of interest that you would get versus a corporate bond would be lower. And municipal bonds are attractive to high income tax bracket investors. So the more income that you have and the higher your tax bracket makes municipal bonds more advantageous. The last bond that we want to talk about is the corporate bond market. And corporate bonds are direct obligations of specific issuers in the private and public space. Again, they're riskier than government bonds, but in turn, they will offer a higher yield. And there are different maturities, just as there are with treasuries and municipal bonds as well. They offer short, medium, or long-term types of maturities. Highly rated corporate bonds will carry little risk, and then the interest earned on corporate bonds is taxable. Just to say a little bit more about corporate bonds, I like to think of corporate bonds like we do our own personal credit score. Again, the higher our credit score, the lower amount of interest that we'll have as far as the investment component goes, as far as what we have as far as our interest rates and when we borrow. The same things goes for a corporate bond. Again, as far as AAA rated bonds, there are only two companies right now in the entire United States, Microsoft and Johnson & Johnson, that carry a AAA rating. The rating system goes anywhere from AAA down to what's called a high yield or a junk bond. So there are a lot of variations with regard to the bond. You just always want to measure the risk and the reward when it comes to type of investing in corporate bonds. Again, when we talk about the size, corporate bond market right now is between 10 and 11 trillion dollars. And with regards to municipals, that market is the smallest that we'll measure, and that's between 4 and 5 trillion dollars. So that just gives us a brief overview on talking about bonds and how they actually work. The next topic we'll look at will be equities. Again, this is the thing that most of us will see when we go home and watch the news at night, or when we're looking at things on our phone or on our computer. Equities are also commonly called stocks. And so let's talk about what a stock is. A stock reflects a person's ownership of a corporation, represented by the shares that a company claims as far as their earnings and their assets. Again, your claim on assets is only relevant if a company goes bankrupt. So again, if we're all owners in a specific company by equity share, we would all own a position or a portion of that specific company. Again, stocks are pieces of the corporate pie. When you buy a stock, you buy shares in a stock, and then you own a slice of that specific company. A corporation shareholders all have equity in the company, or they all own a fractional portion of the entire company as a whole. They buy stocks because they expect that the company will be able to profit. And in turn, when the company does, the shareholders of the individual equities would tend to profit as well. Owning stocks gives you the right to vote or on company issues as far as policies go. So some stock will carry shareholder opportunities to vote or be able to make your voice known. So again, it gives you an equity component. A stock's value can also change at any moment, depending on market conditions, investor perceptions, or a host of other issues. Again, and sometimes we would like to think that they were all economic in nature, but sometimes there's emotional things that go on in the market as far as sentiment goes as well. Again, we've experienced a lot of this over the last few weeks with regard to the election and everything else that's been going on with the pandemic. Again, by way of trading, again, the stock market, the New York Stock Exchange and the NASDAQ markets are open from 8:30 Central Time until 3 in the afternoon. So anytime between 8:30 and 3 in the afternoon, stocks are open to be traded, and they can go up and they can go down, and they can keep the same in value every single day that's trading is open. Again, stocks that pay regular dividends are what's known as income stocks. Stocks that pay little or no dividend while reinvesting their profit directly into the company will be known as a growth stock. And so we'll talk to some of those things moving forward. Stocks have what's called a market capitalization. Market capitalization is a measure of a company's size. And the way that you calculate a market cap will be the total number of shares that are outstanding by the share price. And this is where you have conversations on talking about how big companies are. So right now, the 5 biggest companies in the United States, as measured by the S&P 500, will be Apple. So we see that on our cell phones or on our computer and technology. The second largest company would be Microsoft, another technology company where we're all familiar with. The third company would be Amazon. Again, if your house looks anything like mine, again, sometimes you're amazed at the number of boxes or things that show up via Amazon. So they're the third largest company as far as market capitalization goes. The fourth largest company is Google. Again, Google, a major search engine on the computer. And then rounding out the top five would be Facebook. Again, social media platforms, having the opportunity for Facebook and Instagram and other things that they're able to use as far as their platform goes. Brokerages will vary on the exact definitions between stocks as far as their market cap goes, but I've listed a few as far as the approximate classes of market capitalization on your screen. Yeah, the first thing would be large cap stocks, which we just mentioned with the five that we talked to. Generally, these are the largest and the most recognizable companies. So the companies that you think about off the top of your head will be large cap in nature. Large caps are considered to be relatively stable and secure. Many large cap stocks are referred to as what's called blue chips. So if you've ever heard someone mention a blue chip stock, they're usually representing a large cap stock in nature. And what that means is that company is a well established and financially sound company that demonstrates its ability to pay dividends in good times and in bad times. Going down as far as market capitalization goes, it's a mid cap. The mid cap space is typically between $2 and $10 billion in market capitalization. These are generally mid-sized to smaller companies, not as widely recognized. Some names there that you would mention and be familiar with would be Dunkin' Donuts or Dunkin' Brands, or also Grubhub, again, where a lot of us are staying at home right now, maybe getting deliveries from Grubhub. Mid cap companies are generally considered to be more volatile than large cap companies. Again, some of the companies may not be industry leaders, but they're well on their way to becoming large cap in nature. So the market cap for a size of mid cap will be between $2 and $10 billion. I made mention of large cap beforehand. Apple is the largest company that we reference. Their market capitalization, to give you an idea, is over $2 trillion. Lastly, we will mention small caps. Small caps are typically new or relatively young companies. Their track record won't be as lengthy as what large caps will be, but they present the greatest opportunity for capital appreciation. But in turn, by them being smaller or newer companies, they would also offer a greater risk than larger mid caps. When we talk about stocks, we mentioned domestic stocks. You can also invest internationally. Again, investing internationally, again, is the ability to invest in foreign companies, and that's dramatically increased over the last number of years. Again, with the advent of technology and us being able to trade in a global environment, it's easy for you to be able to buy a stock that's not based here in the United States. Good examples of that would be Toyota or Nestle that will trade here in the United States, but are foreign-based companies. By buying securities in different markets, you can reduce the impact of a country or region specific risk and possibly increase your returns. And that talks to the idea of diversification. And we'll be able to talk to that in greater detail as we move forward. So again, as we talk about developed markets internationally, those will be countries with well-established capital markets and modern economies. Again, think of those as such as Europe, Japan, Australia. Again, their growth will tend to be slower and stable. Developed markets are typically democracies that follow the rule of law and have effective governance. As opposed to emerging markets, these are countries that are starting to participate in the global economy by implementing reform programs and undergoing economic improvement. So when you think about the emerging markets, you will think about Brazil, China, India, again, Russia, Mexico. Their growth will be faster, but in turn, they're more volatile. Because emerging markets are in political or economic transition, sometimes those countries in investing in emerging markets would have a greater level of risk associated. Now, as we talk about bonds versus stocks, there's some things that we want to make sure to identify as we try to reduce the stress and anxiety of investing. We always encourage you to know yourself. Again, when you talk about risk, again, if you're worried about risk, then it's something that we want to be mindful of. And so that will limit the universe of things that we'll want to invest in. Again, by comparing, contrasting, a bondholder will own the debt of a company where a stock would own equity. Again, owning debt gives the bondholders a higher claim on assets in the event the company goes out of business. So if the company goes out of business, the bondholder would get their money back before an equity holder would be. In turn for taking that additional risk for stocks, shareholders share in the company's profits and they may be paid regular dividends, where a bondholder is only obligated to receive the debt that they've lent plus some level of interest. And then lastly, again, stocks are more volatile and therefore they're more risky than bonds, but in turn, they will generate a higher return. And so when we talk about something as far as the capital structure goes, Again, the common stock would be on the bottom of the poll. Again, as far as what we would do as far as our risk reward piece, we would have the opportunity to get the greatest level of reward, but it takes the largest amount of risk when we talk about common stock. Moving higher up the capital structure is something called preferred stock, where we won't have as far as our conversation today, but it gives an opportunity where it's a hybrid security where it would have components of a bond or debt, but it also would trade like a common stock or an equity. And then lastly, at the top, the most secure thing that you can buy from a corporation, as we've talked about beforehand, would be some level of debt in the organization. When we talk about some of the key risks to investing in bonds and stocks, there are 5 components that you'll want to consider as far as the risk go. Again, first would be price risk. Again, any day, a bond or a stock either can do 3 things. It can go up in value, it can go down in value, or it can stay exactly the same. And so price risk, where you're exposed to the risk that the value of the holdings may decline in the future. And then it talks about the opportunity for equities as well. Again, the risk there is that you'll lose money to the fall of the market price in a stock that you individually own. So there's big differences between the bond and the stock as far as the price risk goes. The default or the credit risk goes, if a company goes bankrupt, the bondholders are senior, as we mentioned on the last portion, to shareholders in the company's capital structure, and they get paid first. So if after we pay all the debts and everything that goes along, if there's something left, the common shareholder will receive the residual portion. If there's nothing left, then you lose your entire investment. Next risk that you'll want to discuss is inflation risk. Again, for a bond, the inflation risk is that the risk of the investment will not grow at the rate that may be in excess of inflation. So the real return could actually be negative. So just to give a simple example, if we're buying a bond that pays us 2%, but inflation is at 3%, we're making money, but we're losing what's called our purchasing power. So the investment is not keeping up with inflation. And so for that opportunity to the mall or to the grocery store, when the things you could have bought for $100 a year ago, now you have to pay $95 or $96 or $97 to get that same level of good. That's the inflation risk that's there. So any of our investments, we want to make sure that we have a good balance between those that are keeping our purchasing power consistent, and then also with the opportunity to be able to grow, to be able to gain in our assets. Next thing you'll look at is exchange rate risk. That's if you're investing in foreign currencies. The risk will be that our value of our dollar may go up or go down, and that's a risk that's there. That's not something that you'll really have to worry about if you're investing only in dollars. That comes mostly according to plan if you're doing something with regard to currency. Liquidity risk is something, again, how fast can you get your money back? As we mentioned, as far as our bonds go, again, our bonds would have a longer duration, anywhere from a few months out to a number of years. So that compromises some of the liquidity that's there. Where an individual stock, if you own a stock in a publicly traded company, you can sell that stock any given day, and the funds will be available to you in just a number of days. Another thing that we'll talk about as far as investments go will be a different type of investment vehicle, and it's called mutual funds. A mutual fund is a collection of stocks, bonds, or other securities owned by a group of investors, and they're managed by some type of professional investment company. Again, when we have an open-ended fund, all shareholders share equally in gains and losses in the fund, and the shares are redeemable on demand at what's called a net asset value of the fund. Mutual funds are good in the fact that they pool all the money together, and then other investors will create a larger investment. It gives more buying power than what you would have as an individual. And so having the opportunity to own a number of different individual stocks would be better served in a mutual fund, where you can get diversification and buy a number of things, as opposed to buying the individual stocks, where it may cost more money to be able to get diversification that way. The reason you invest in mutual funds, as we've talked about, again, mutual funds diversify across multiple securities. Again, so it's the good idea of owning a bunch of different companies as opposed to just a few. In some cases, mutual funds will diversify across multiple industry sectors. So there are 11 sectors that function in the market. And if you want to own all of them, a mutual fund is a wonderful vehicle to be able to do such. Investors in mutual funds benefit from the research, security selection, and active management of a professional money manager. So that's someone that is buying and selling securities on your behalf every single day. And the goal will be to get some level of excess performance from their expertise as far as research and selection of securities. Another type of security and vehicle that's fairly newer, again, although being around since 1993, is what's called an exchange traded fund, or you may have heard of something called an ETF. An ETF is a security that tracks an index, a commodity, or a basket of assets and trades on an exchange like a stock. A well-known index is the S&P 500. This index is based upon the market capitalization of the 500 largest companies whose shares trade on either the New York Stock Exchange or the NASDAQ, and is considered to be generally indicative of the entire U.S. economy. So when we talked a few moments ago about those 5 largest companies, they are all within what's called the S&P 500. So if you were to buy an ETF with the S&P 500, what's commonly called a SPDR, you would have ownership in all of those companies that we talked to. Again, the SPDR tracks the S&P 500. When the index is up, the value of the ETF also rises. But in turn, when the index is down, the value of that ETF will also fall as well. Exchange traded funds are what are called passive investment strategies, that they do not attempt to outperform the market, but rather mirror the performance of a specific index. So you'll buy an ETF when you want to have the opportunity to just participate in the market. Your goal is not to be able to try to outperform, but you want to take the same level of risk and return as what the market does and be comfortable with those results. The reason that you'll invest in an ETF, ETFs carry with them the diversification of an index fund. The S&P, as we mentioned, is a broadly weighted across multiple industry sectors. And so you have equal weightings that are there that represents the entire S&P 500. Mutual funds and ETFs are different, though. Mutual funds trade only once a day at what's called a net asset value, where an ETF will trade like a stock. So you can have the ability to buy an ETF, as we mentioned, between 8:30 and 3 o'clock in the normal market times that are available. And so ETFs will trade like a stock, but they're diversified like a mutual fund. So it gives you some of the benefits of both. The last thing I want to focus on for the top of our conversation briefly is talking about an alternative asset, which could be known as private equity, real estate, or some type of commodity or hedge fund. Now, broadly speaking, alternative investments are any investments that are not either a bond, fixed income, or a stock that's an equity. And as we mentioned, these alternatives could include a hedge fund, private equity, real estate, or commodities. Now, they'll have their pluses and their minuses, but just know, again, they're alternative in nature, not to be designed for the majority of an overall broad-based portfolio. Alternatives in nature can be highly risky investments, and investors can stand to lose up to the full amount of the capital that they invest. So with a hedge fund is a security that has no public market coverage. Investors are relying on a specific manager for the availability, the quality, and the quantity of the information that they receive. Private equity would be the same. Again, little or no market coverage. It's harder to gain information, but private equity would be the opposite of a publicly traded security, as we mentioned, that would trade on a normal exchange that has a stock ticker symbol. Private equity investments don't have such. Real estate, we all probably do a little bit of now, either through our homes or some type of investment capital. Again, real estate is the same. Again, doesn't trade on a specific exchange. Location is important. In real estate, we usually look at it as dual feature, and sometimes we live in it, and we also choose it as an investment. And then lastly, a commodity would be something in the fact that, again, something that functions as far as a hard asset, be it gold, be it grains, be it opportunities for hard assets as far as metal goes. And you buy those, again, you're trading and you're looking at something to be able to hedge something in the market. A lot of times people will look at commodities as a good place if they're looking for stores of what's called inflation. When we talk about risk and reward, we mentioned this as well. Again, talking about a balanced type of portfolio. As we've discussed over the last 20 to 25 minutes, every type of asset class carries with it some degree of risk. In general, the greater the risk in an investment, the greater the possible return, or consequently, the greater the return of potential loss. Stocks are higher in risk, but again, in turn for the risk that you're taking, they offer the greatest potential for an opportunity to gain money or even to lose. Bonds are typically lower in risk. However, they will offer little opportunity for a significant type of return. It's also important to have a balanced portfolio, meaning that your investments are a combination of high risk and low risk investments. And that's where it talks to a specific nature. Again, if you're risky by nature, your portfolio would skew more to equities. If you're more conservative, again, your portfolio would skew more to type of fixed income or more conservative investments, to making sure that the preservation of capital will be the primary goal. The power of compounding is something that we always want to illuminate as we talk to these type of varying options, again, in risk and reward. I put up on your screen, for those that are able to see the slides in the handout section, the power of compounding just talks about the S&P price performance versus total return, and just taking an investment of $10,000. I ran this number back for the last 50 years. So if you started with $10,000 and you had the opportunity to invest in the S&P 500 over the last 50 years, when you included the dividends that you would have reinvested over that time period, $10,000 would be reflected at the end of last year at $1,568,121. So a wonderful opportunity for growth. Now, obviously, there are ups and downs that have gone over that period of time in the last 50 years, but to start with a $10,000 investment and to end 50 years later at $1.5 million is very substantial. I've also looked at major asset classes that we've talked about during our time together as well. I took that chart back out till after World War II, back in the late 40s. And I made reference here as far as the investment goes. I also took $10,000 and I logged it as far as what it would actually be. The growth of $10,000 from 1947 to 2019. And I looked at it with regard to small cap stocks, large cap stocks, bonds, T-bills, and inflation. And so just your normal purchasing power, again, when you had the $10,000, again, $10,000 in today's dollars would be equal to $114,000. So the same level of investment in money that you had if you did nothing with it, just by the rate of inflation, that $10,000 turned into $114,000 in today's dollars as we measure. The next thing, as far as the most conservative investment, would be as far as our T-bills. And those are the bonds that we made mention that come directly from the government. The $10,000 there would be reflected today at $173,000. Stepping up the risk spectrum that we talked to would be a general bond. General bonds would come from corporations. The $10,000 would now be $883,000. Moving up to large cap stocks, we made mention of in the conversation earlier, the $10,000 goes from 1947 to 2019 to $24 million. So a wonderful rate of return there. And then lastly, with the small cap stocks, the $10,000 turned from $10,000 to $73.8 million in the last 70 years in looking at this data. So again, gives you some investing principles. Again, nothing is a straight line, so there's no opportunity to say that we promise returns or the risk and reward conversation shouldn't be had. This year is a good example. Again, when we reached our all-time highs just before the pandemic really onset, that was back in February, on February the 19th. The lows of the stock market were on March the 23rd of this year, and that's when a lot of us were really under the stay-at-home orders and started to really work from home. But since then, the markets have not only rebounded in gains as far as the equities go, the stock market through yesterday, as represented by the S&P 500, was up over 14%. So with the ups and the downs that we've seen this year has been phenomenal for a number of reasons. It's the first time in history that we've reached all-time highs and also reached a low within a specified period of time, being so short it was in over a month's period of time that we saw earlier in the winter and going into the spring in March. When we discuss risk and return, thoughts, I say it for young investors, but also for more mature and older investors as well. Risk versus return is a trade-off that every investor must make. Investors must make the decision about their own personal situation and risk and return and how they will allocate their portfolios. Again, if you're new to investing and you're still of working age, you probably are more likely to take more risk than what an older or more experienced investor would be that has a shorter time horizon. Young investors often allocate a portion of their portfolio to stocks, and riskier assets in turn would have higher levels of future growth. With retirement being more in the future, young investors have more time to let their investments grow before they're likely to need them. I throw the inverse out there as well. Again, if you're older or looking at retiring or have specified goals such as educating your children or taking care of your parents, your portfolio may want to be moderate to have more conservative types of investments because those costs may be more immediate in nature, and you would have a greater need for the money on a specific basis, really coming up to speed in a shorter time frame. But as always, again, a qualified investor and qualified investment advisor can help you determine what is the appropriate level of risk for your specific situation, and then in turn recommend strategies for an overall portfolio allocation. Some tools and some resources that we've added to be able to talk to the investment journey and being able to minimize some of the stress and anxiety that goes along with it. Again, keeping current on world events and financial news. Again, your money will never sleep, so make sure that you're informed and stay up to date. Again, read some opportunity for resources, be it in the paper or be it online with a number of resources. Wall Street Journal, Bloomberg, Google Finance, Yahoo Finance. So just a number of tools that are available to be able to help you do and monitor the environment that we're in. And then also doing some research on investments. Again, being a well-informed investor is key to being successful. So you want to gain as much information that you can to be able to help you make more informed decisions. Again, there have been studies that have been published and documented that most people will spend more time planning their family vacations than it would for making their allocations in their 401k or their retirement account. So as much as possible, we want to make sure that we're making informed decisions. And if you don't have someone that you work with, you'll want to find someone to be able to help navigate those situations for you. And then always, before making any investment, you should learn about it and then track some type of performance. So with that we hope that this opportunity has been beneficial. We want to take the time now to open it up to have a question and answer format with any questions that you have as far as investing goes.
Thank you, Robert. That was amazing. That was very helpful and concise, and I learned from it as well. We have a few questions. I have a comment, and maybe going back to my own personal history with investing. I remember I came to this country. I was born and raised in Syria, and I came to this country in the early 1970s, 1974. And I remember I learned about the stock market, and I was interested to see how people invest and all that stuff. And I reached out to a friend who had been living in this country for a while. And I said, what is the best thing to do? Because I don't have a lot of money and I wanted to invest. What should I do? So he made me a really interesting recommendation, which was that have carried me throughout my entire life in the United States and my career of investing. Is he said two things. He said, invest in what you know. And what you know means is like if you know and understand. And number two, invest in what you use. For example, he said, take a look at the utility company that service your apartment. At the time I was living in an apartment, and I was living in Pennsylvania, and it was Pennsylvania Power and Light. So I found out that by paying a little extra on my utility bill, I can actually invest and purchase stocks in Pennsylvania Power and Light. And then, trust me, between 1975, I came to the country at that time, between 1975 and the time I purchased my first home, and that little bit of investing that I did on my utility bill, I had literally $25,000 of down payment that I was able to use towards the purchase of my first house. So I think investing in what you know and investing in what you use is actually, what do you think about that?
That you made mention of your own personal situation. Again, there are two things that you mentioned. Again, talking about what you use and what you know. Again, anything that we use will have some level of familiarity with it. So if you're able to benefit for something that you already know, it helps you as far as the research that you'll do because you'll have a general interest in it because it's something that you know. And then something that you use, you view it as a consumer. And so when you're looking at it through the idea of being an investor, I do it with my boys. I have an 18-year-old son and I have a 15-year-old son. And it seems like they always come to me, hey, Dad, I need money, or I need a pair of shoes, or I need a new phone. And so we'll look at Apple as a stock, or we'll look at Nike as a security. And so instead of just having something that you wear on your feet or something that you talk on the phone with, it gets you in the mindset of being an investor and having the opportunity to really build that passion for investing, because a lot of it is discipline. Again, Addo, again, from a financial and from a physical point of view, you are very disciplined. So again, it would be easy for me to say, hey, I'm going to go and run a marathon. But if I haven't trained to be able to do it, it's going to be hard for me to make sure that I'm doing it on a consistent basis. The investing is the same way. Again, doesn't matter the dollar amount. It matters the time that you have. And so that's some of the things that we illuminated in the presentation. If it's $5, $10, $20, whatever the case may be, there are a number of different ways that you can invest now that really lowers that barrier of entry. And I believe personally, again, that the stock market is the greatest wealth accumulating device that most people will get. So instead of the $5 or the $10 or the $20 that you may give away, there are wonderful programs that you can invest now, and you can actually be owners in investments as your portfolio grows.
For kids, and I remember when the kids were small, I went around the house and I wrote down the manufacturer of every product that we were buying, from diapers to baby food to all of that. And I decided, you know what, I'm going to make a list of those, because those are the ones I'm going to be investing because I'm using them. And it turned out to be Johnson and Johnson and Procter and Gamble and some of the other big blue chip companies, and it really paid off well. Well, we do have a few questions. How do you compare index fund to ETF and mutual funds?
Okay, good
How
question
are they?
again.
Yeah.
Go ahead, Adam. I'm sorry, I didn't hear the
No,
last part.
that's a question. What is the difference between an index fund, like an S&P index fund, or and then the other two funds that you talked about, which is the mutual funds and the ETFs?
Yeah, that's a good question again, because those things are just really thrown out a lot in the public as far as investing goes. It talks about the specific vehicle that you like. Again, all of us with regard to transportation will get in some type of vehicle. Now, some of us will prefer, a sports car. Some of us will prefer a coupe or a sedan. Some of us will prefer an SUV or a bus. But the whole idea would be some level of vehicle. So when you look at an index type of opportunity, the vehicle that you choose is the personal preference. You can buy a mutual fund that's an index fund. It has the capabilities of a mutual fund where you get all of the stock that it's in that specific index, be it the S&P 500 or the Russell 2000 or whatever index that you're looking for. But a mutual fund would only trade once a day, and that trades at the end of a day, and it's represented by its net asset value. If you want to have something that's more tradable or something that mimics the ability to be able to buy it and sell it at a greater frequency, you would use an ETF, which is an exchange traded fund. The exchange traded fund will be able to mimic a specific index. So this example that we just referenced would be the S&P 500, or what's commonly called a spider. A spider came out and was invented in 1993, where it trades like a stock. You're getting the entire index, but you can buy and sell it intraday between the market hours of 8:30 in the morning Central till 3 in the afternoon. So just differences as far as the vehicle goes, some of the cost that's associated with it, and then the level of trading that you're looking at for your own specific situation.
Much larger basket of stocks
In the
than
index
the
fund, you're buying the entire index. So if it was an S&P mutual fund, you would have technically 503 companies that are in there in the S&P 500. And then in the ETF, you would have that same number, but the ETF would trade like a stock where you can buy it and sell it throughout the day if you like, where a mutual fund would only price once a day, and that's for more longer term types of investments. So if you're investing in your 401k or your retirement account, you may not have the opportunity to buy the ETF, but the mutual fund will be available for you to be able to purchase because it's longer in nature as far as the retirement planning would go. But the investments would be underlying the same once you look under the hood, just like our cars would be. Again, some cars go slower or faster, but the whole idea would be a vehicle to get you from point A to point B, and there are different variations that go along with that. So the idea would trade in a mutual fund or in an exchange traded fund.
We have a question that says, what type of retirement account should I have?
Okay, that's a wonderful question. Again, as we get older, again, the demographics of the country say that a lot of people are really gearing towards their retirement. Again, with the loss of other social services programs as far as pensions go, or relying on Social Security, again, our retirement is most important because we'll have to primarily fund it based upon your own spending patterns and making sure that you're investing for it. So when you retire, when you're looking for retirement, again, if you're still employed, again, if you have some type of deferred type of retirement plan, so a 401k, or if you're a government or employee, or if you're a teacher, a 403b. If you work at a corporation or an entity that doesn't offer those things, you can have what's called a traditional IRA. An IRA stands for an individual retirement account. You can also have what's called a Roth IRA. A Roth stands for a Roth, and that's an IRA account as well. There's some differences there as far as the tax treatment goes, but the idea would still be the same, where there's money that you'll want to set aside either on a daily, a quarterly, or a monthly type of basis to be able to gear towards retirement. So if you're still benefits that are associated with it based upon where you work, where they may offer some matching dollars that may become yours. Or if you don't have the opportunity, you just want to save from the income that you have, open up a traditional or Roth IRA to make sure that you're funding your goals and helping contribute towards your retirement.
Well, Robert,
Adam, was that
that's better.
okay? Can we hear? We'll take that last question again if you want to present it, Adam. I can answer that as well.
Yeah, yeah. I think the last question was the question was about the type of retirement accounts should I have.
Yeah, and we make mention again, if you're employed, again, your employer, most employers will have some type of opportunity as far as your retirement plan goes, either through a 401k, or if you're a teacher or a government employee, it may be called a 403b. The whole idea would be some level of pre-tax income that you have from your paycheck to be able to go directly towards your retirement. So that would be an opportunity. If you don't have the opportunity through your employer, you can have what's called a traditional IRA. Again, IRA stands for an individual retirement account. There's also something that came about in 1997 called the Roth IRA. And the Roth also is a treatment for your IRA as far as retirement dollars go. And they're treated different as far as tax purposes go. So a traditional IRA would be different than what a Roth IRA would be. But the idea would still be the same in nature, that you're trying to fund your own retirement. So with the idea that we're living longer, with the idea that a lot of corporations have gone away from a pension format, and the opportunity where Social Security doesn't provide for a majority of income that you'll need, we want to encourage each of you to participate in some level on funding your own retirement when you get to that situation.
Cool, cool. Well, the next question is that I already have a retirement account and I want to start investing towards another goal. How do I go about this?
Okay, that's another good question as well. Again, sometimes we would like to silo everything that we do in life, but it really always goes together. So I always tell the people that I work with, my clients and people that will ask me, again, it's not either or in nature, it's both and. So you've already done a good job starting for your retirement. Now you'll want to take assets as far as investing for, again, other issues you may have as far as buying a home or educating your children or doing a number of different things in that arena. You would segregate those assets and open up a taxable account to be able to do such. So there are a number of providers that are out there that where you can have the opportunity to do so, but the risk and reward should always be a conversation that you'll have. And so if retirement is further along, again, maybe you're more growth oriented in that type of account, where if you have a specified need, again, if I need the money today, tomorrow, or sometime in the immediate future, I want to be more conservative with those assets just to make sure that they're there when I need them. So just depending on the goal, again, you would want to set up some opportunity to share and discuss what the pros and the cons would be on the different types of investments. But if it's not a retirement goal, you wouldn't use your retirement account. There may be tax implications as far as distributions go and the like. Again, in talking to your own specific situation, you want to have what's called a taxable account to be able to meet any other specific goals where you can get access to the money in a faster format.
A question here. I have a combined income with my wife of $100,000, and we have $10,000 saved to invest. Where should we put it?
Wow, that's broad-based. Again, in general, as we've talked about, if you're new to investing, not knowing your specific situation, but I'd always want to have it go back to what your specific goals and your objectives are for the money. Again, if the $10,000 that you make mention of is to be able to send, again, one of your children to college, that would be a different type of conversation versus something as far as buying a home. Or if it's not buying a home, if it's something for retirement. So having know more about your situation, again, I defer to what Addo mentioned in the beginning. I would start with something that I would know or something that I would use. If it's equity based, again, think about it on a scale of 1 to 10. Again, 1 being the most conservative, 10 being the most aggressive. If you don't know where to start, you'll know between, as a couple, again, I know in our house is always a good example. I'm more growth oriented than my wife, so we have to find something that's in the middle. So in your own specific situation, when you talk to what the goals and the objectives are, think about what your risk tolerance would be. And a good example would use, if you're middle of the road, a 5 or a 6, that would represent the amount of equities that you would own. So in the example that you gave, again, if I had $10,000 and I was middle of the road, if I was a 5, I would find a vehicle where I would have 50% of my money in stocks, and then I would have 50% of my money in fixed income or bonds to be able to give me some level of balance if I'm just starting out. So that's a broad-based answer to a specific question, but it all depends upon your goals and your objectives, the time in which you need the money, and also the risk tolerance associated with the funds that you have.
Question is about how much should I pay attention to taxes when I'm investing?
Addo, I didn't hear the first part of the question. If you can repeat that.
How much attention should I pay to taxes when I'm investing in the market?
Yeah, taxes are a consideration. Again, we don't want to be ignorant of what the ramification of taxes will be. Again, if the money is outside of a retirement account, we're in a retirement account. The good part about it is we don't have to worry about what are called capital gains or capital losses. And we didn't talk a lot about that, but we'll talk about that briefly. A capital gain means that I bought something that's appreciated in value. So I had the opportunity to buy an investment of a stock that was at $10 a share. That stock went from 10 until 12, and I decided to sell it. I made $2 on the stock that cost me $10, so I had 20% appreciation in the security. Now, the capital gains and capital losses will work as far as the time period goes. Your capital gains are based upon your individual tax bracket if you sell it within 365 days. So if we bought an investment today on December the 16th and we decided to sell it before next December, we would pay what are called short-term capital gains, and that's represented by your personal tax bracket. Again, longer-term capital gains would be anything that you own in greater than a year time period. So that same example, if we buy something today in December the 16th, and we don't sell it until January of 2022, that's a long-term capital gain now, and the long-term capital gain rates are more beneficial than what the short-term will be. So the opportunity of considering taxes should be a major consideration, but it shouldn't be the only decision that you make if you need money, if you have the opportunity where the security is really appreciated in value and met the goals that you've identified, or if there's something that changes in the market. So all of those things should be considered when you're talking about buying and selling a specific investment.
Cool. I have a question here that just popped in. Investor sentiment is such a fundamental driver of the stock market. It often seems that valuation can get quite inflated, like in Tesla stock. Can you address some advice for clients dealing with fear of missing out, FOMO, which is a term I'm not familiar with, and perhaps chasing equity investment of unrealistic levels, or the opposite, not being able to put the cash to work due to fear of buying at potentially inflated levels? Very good question.
Yeah, and that's a wonderful question, especially with everything that we've seen this year. we made mention on how the market has been so volatile this year. Again, just where we started out the beginning of the year and not knowing what COVID meant at all, and having the opportunity where the markets were down a bunch back in March and then rebounding to their levels now. Again, coming into yesterday's closing, there was over 50 times where the stock market reached all-time highs this year, as represented by the NASDAQ market. So some of those things, when you have that FOMO or fear of missing out, you never try to time the market. Again, in timing the market, you have to be right on two occasions. You have to know when to get out, but you also have to know when to get in. So it always goes back to those goals and objectives that you've identified. If you segmented in your mind as far as the investment goes that these are short-term, intermediate term, or long-term dollars, those should be the things that you represent, irregardless of what the market does on a specific day. Again, Tesla is an example of a very volatile stock. Again, it goes up, it goes down. It's had a great run again. And so without knowing your own personal situation and talking about Tesla specifically, again, Tesla has grown to such a degree that it'll actually be added to the S&P 500 on next week. So again, in buying a broad-based investment, if I haven't started investing, that may be a good place to start, where I don't have to have the individual risk or having a specific concentrated security, where I can have a broad-based investment plan as far as owning in the S&P 500 specific companies, as opposed to really just placing all of my resources in one specific company. So the idea of making sure that we're timing the market or making sure that we engage, again, sometimes that causes you to miss out. But you can look at any study that you like, and that's why we're so fond of the equity markets. Again, if your time period is longer in nature, you can look at any 20-year rolling period in the history of the stock market. And if your time horizon is such, there's never been an instance, including, great financial recession, September 11th, stock market crash of 1987. There's never been a time period over 20 years where you've lost money. So if you started with $100, 20 years later, in any instance that you measured, you always had more than $100. So sometimes it's good to be able to think in a longer term mindset. If you don't have the dollars to be able to match that time set, then you'll want to consider some type of alternate investments to be able to match your situation. Again, my own personal example, as we mentioned, again, my son just finished up his first semester in college. He came to me yesterday on the computer and he showed me his tuition bill for next semester. So the dollars that I consider for retirement or other goals that my family have, they can't be placed in those type of investments when I need to pay his tuition bill in just a few weeks. So you'll want to match up the goals and the objectives that you've identified and make sure that you're choosing specific vehicles to help get you there in the most effective way possible.
Yeah, I think fear and greed. The battle of the fear and greed in the market has been a big challenge, and chasing a stock that's running up, is all about a mixture of both. You're afraid that if you buy it high, it's going to crash, but then you really want to make money, so you want to buy it as it's running up. So there's always that battle between fear and greed, and how do you balance that? Well,
that's a good thing you mentioned, Adel. Again, I'm sorry to cut you off. Again, just a good thing to mention as we wrap up. Again, that's why the emotional piece, again, if the stock market or investing were easy, that's where we get a lot of the anxiety and the stresses that come. So again, hopefully this hour has helped to really lower some of those things. But again, if it were easy and if it was all based upon fundamentals, we would all buy the same thing and we would pay the same price. The beauty of it is everyone will have a different opinion. There'll be different things going on in the economy or the environment. And sometimes that momentum is just really hard to stay away from. So again, that's where that FOMO idea comes from, the fear of missing out. Again, by and large, when the stock market is at an all-time high, that usually represents that things are going well. But inversely in our mind, it tells us that, hey, something is too high. I have to wait for a pullback. But if that pullback never comes, now you've missed the opportunity to invest. And so, again, hopefully this time has been beneficial just as an education point of view. And anything that we can offer as far as resources or anything to answer any questions specifically, we'd be more than happy to do so.
One last question. How often should I check my portfolio?
Those supercomputers, again, they make it awful easy to be able to do it. Again, I've been in the business managing money for clients since 1998, so that's 22 years, and I don't know how people can look at their portfolios every single day. And just with the time and the amount of energy and effort that goes on, again, I would make it in line with the portfolio. Again, it's easy for us to be able to look at it, but looking at it and acting on it are two different things. So again, sometimes in this social media generation where information is just ready at our fingertips, when I first started in the business, again, I just had to wait for the daily paper to come, and I would get information that way. Now I can pull up my cell phone or my computer and I can see anything that's there. So
Oh yeah.
behavioral finance or the emotion part says, hey, let me go and look. Well, you don't want to do that because sometimes it's more short-sighted in nature. So I would say be abreast of what's going on in your portfolio, but there's no need for you to look at a specific day unless you're doing something that's very specific or short-term in nature. So that's the long essay version to a short answer question.
Robert, thank you. That was a wonderful answer. And I thank you so much. This was a great hour. I enjoyed it. I'm sure our audience enjoyed it and they would listen to it more. So thank you very much. And thank
We
you.
appreciate it.
Yeah, you bet. And thanks all of you for watching us or listening to us. And please keep us in mind when your profits are high. Remember the abkf.org. We can always benefit from your support because this allows us to do what we're here for, is to help people who have mental health challenges to live a better life. Thank you so much for all of you, and I look forward to seeing you in future webinars. All the best.